Hey everybody, it's John King with Summit Funding. It is Friday the 6th of December, and here I am with my weekly market update. I missed you guys last week. I did not do a Thanksgiving video. I was on vacation with my family for the holiday. Hope everybody had an absolutely wonderful Thanksgiving holiday. Let's dive in and get started. There's a lot to cover today. So first and foremost, the jobs reports this morning. Every month, the first Friday of the month, the Bureau of Labor Statistics comes out with a report that talks about how many jobs were created or lost last month. Well, we had a good number of jobs that were created last month, which is normally bad news for mortgage rates. But here's the thing, it's the story underneath the story that matters more. If you remember back to the first Friday in November, we had a very small number of jobs created, and yet the interest rates went up, and it was kind of backwards. And part of that was because nobody believed that report. Everybody thought, you know what, that report isn't true. There were the hurricanes that had gone through and they hit the eastern seaboard. There was a strike. I think it was Lockheed or Boeing that had a strike. And everybody's like, hey, those numbers aren't real. That number is going to get revised in December. Well, guess what? It didn't get revised. The number, it got revised, but a little bit. So it went up just a little bit. And so everybody thinks now, wait a second, maybe that was real and we did not create very many jobs in October. And although we created a good number in November, the market is undoing its expectation of what it created a month ago. And really that comes down to, if we look at timing, and let me share my screen right now and kind of show you how this plays out. So if we look at the 10-year treasury, which is the best indicator of kind of what direction interest rates are going, and let's zoom in a little bit on here. So what we're seeing is that, in October, rates were actually pretty good. Now, this is not mortgage rates. These are the 10-year treasury rates, but the 10-year treasury in October had hit its kind of low at mid-September and then gone up a little bit in October, and it shot way up starting October 1st. And through October 10th, the rates have moved up even more, and then moving up even higher by the time we hit the end of October, and then they're staying even higher. So we hit this jobs report in November, and rates hit their peak. Then they kind of started getting a little bit better and a little bit better. And we started seeing better interest rates over the last 2 weeks. So that's good news. Basically, 2 weeks ago, we were looking at 30-year fixed rates at 6.8% on average. Now we're maybe 6.5% on average. Again, lots of things that impact that average, but it's good news. We're seeing interest rates come back down a little bit. The jobs report is still going to be the number one thing that the Fed is looking at. And this morning, when everybody digested the jobs report, let me move back to me. It was the market now expects 75% chance the Fed is going to drop rates again in December. So in a week and a half, 2 weeks, the Fed's meeting, they're likely to drop interest rates again, which is what's causing rates to be coming down right now. There's a 25% chance they're going to drop rates in January. And we have some Fed members, people who are on the board of the Federal Reserve who make the decision on lowering interest rates, that are saying, hey, might be time to pause lowering interest rates. Whoa, back up a second. You only started dropping them in September. You dropped them 0.5% in September. You dropped them 0.25% in November. Now, maybe you're going to do another 0.25% in December, and we're not even sure whether you're going to do anything in January, and you're saying it's about time to stop. We raised rates so high in order to fight inflation. Inflation has come back down, and now they're saying it might be time to pause lowering interest rates. It's pretty scary right now what the Fed is thinking, and the messages that they're giving is mixed messages. And that's the worst thing they can do, is give mixed messages, because the market doesn't know how to react, which is going to mean you're going to see wild swings in interest rates from day to day and week to week, because the market is trying to read the tea leaves, and the Fed is not making it clear what they see the future being. And they're not allowing the market to project what the Fed's next move is going to be. It's very rocky times. We're going to continue to have rocky times. Honestly, I see the next 3 or 4 months being continuing to be rocky, and maybe beyond that. And that kind of brings me to the root of my topic today, which is the housing market showing signs of stress. So here's the deal. There's some cracks in the housing market that's starting to show. And I want to give you kind of some perspective. I'm running into, I've got one client right now who wrote an offer on a home, got the offer accepted. 48 hours after the offer is accepted, I'm told there's a problem. The seller owes more money than they thought, and we either have to renegotiate the price up or wait for a short sale to be done, and we don't know if a short sale will be approved. Now, what's a short sale, and why is a short sale happening? Because the seller bought their home 2 years ago. They bought their home in 2022 when rates had just started moving up. So we saw interest rates climb in 2022. We had low rates in 2020, low rates in 2021, and we saw interest rates all of 2022 go up. 2023, they stayed higher. 2024, they've now stayed higher. But a lot of people were pushing the concept, and I was talking about it, but I actually only did 2 loans like this. A lot of people were pushing the concept of saying, hey, marry the house and date the rate. So your theory was, hey, this increase in interest rates, this is short term. This is temporary. This isn't going to last very long. And so you have people who bought homes in 2022 because it was the first chance they had to get an offer accepted. They spent 2 years in 2020 and 2021 trying to buy a home and couldn't succeed. And so their lender, their realtor, honestly, all of us thought the Fed was saying that the increase in interest rates was transitory. It was not going to last very long. And so inflation was transitory. The increase in interest rates was transitory. It's going to come back down soon. And so this particular buyer, I don't know the buyer's story, but I'm kind of projecting what I think the buyer's story is. And this particular buyer, I know, bought their house in 2022. They bought it using down payment assistance with 0 down payment. They used CalHFA and their My Home, pretty sure it's the My Home program, just their normal 3.5% down payment. So they had no money out of pocket. This buyer ended up doing a modification to their loan in April of this year. So they'd owned their house for 1.5 years, and they had a modification done. And that modification set aside $100,000 of past due payments. Okay. Now, that doesn't, there's a lot. I mean, how do we come up with $100,000 in 18 months? You're basically, I don't know. There had to be penalties and other things. I'm not real clear, but I know there's a lien on that property for $100,000, and they've only owned the house for a little over 2 years. And that lien is after their regular mortgage and after their, actually, I know what they did. I'll tell you what they did because I just realized it. What they did is they set aside some of their principal balance. So they did a modification for him. So he wasn't past due $100,000. They did a modification for this client, and they set aside the $100,000. Now, part of that was past due payments. Part of that was him saying, hey, I can't afford the payment. I got in over my head, or I lost my job after I bought the home, or whatever his story is. We all have circumstances that happen to us. But here's the deal. They thought that money was forgiven. They thought when they put their house on the market that, oh, well, I got this $100,000 is gone, and now my balance on my mortgage statement shows X amount of dollars lower. And the realtor thought the same thing. I don't blame any of them for misunderstanding. But now this client owed more than what the house was actually selling for. And at that point in time, they're upside down. The seller has to do what's called a short sale, which means they've got to go to the bank and tell the bank, hey, I can't afford to make my monthly payment, and there's no equity in this house to pay off the mortgages. I need to do a short sale. And the bank has the right to say, we think we can sell it. So we're going to just take it back and not let you sell it. We're going to take it ourselves and we're going to sell it. Now, my buyer is sitting in this position right now saying, you know what? This is the perfect house for me. It's at the right price point. And now they're stuck with the conundrum of saying, I've got to increase my offer by $25,000, not because I think the house is worth $25,000 extra. It might be. We'll see when the appraisal comes back. But they've got to increase it by $25,000 simply because that's what it takes to keep the property from being a short sale. Now you ask, John, why would the buyer be willing? Why doesn't the buyer want it to be a short sale? Because the buyer has to wait a long time. You could look at anywhere from 2 to 6 months for the bank to review the short sale and decide if they're willing to sell it. And in that time, the buyer doesn't know what's happening with interest rates. The buyer doesn't know if they're actually going to get their offer accepted, because it's no longer now the seller deciding what they're willing to sell it for, because it's no longer profit to the seller that's impacted. The seller's walking away with nothing. It's the bank that has to make that decision of, am I better off accepting this as a short sale or better off taking it in foreclosure and selling it myself? And this is not the first time I've seen it. Now, I don't want to scare you and say the market is falling and everything is in bad shape. That's not true. But we're definitely in a rough season. We're in a season right now where houses are sitting on the market for longer over the last few months. And more people in lots of markets up and down the state of California, because that's where I'm paying the most attention, are putting their house on the market at the same time. And normally winter is the worst time to put your house on the market. And we're seeing more sellers want to put their house on the market, which is causing the length of time it takes to sell a home to stretch. And it's causing people who are right on the bubble of selling their home because prices haven't gone up much in most markets from 2022 until now. Prices have been pretty stable. So if you were a buyer with zero skin in the game from the beginning, you got into the home, but now you don't have enough money to get out of it because you have to pay your realtor in order to get out of it. You got to pay the realtor's fees to get out of it. And so there's some cracks showing in the market, and we're seeing houses on the market for longer periods of time. We're seeing sellers more willing to wheel and deal and negotiate, but we're seeing more challenges coming up like what I just talked about with this buyer. So just be aware, it's a very fluid market. And I'm not going to sit here and say, oh my gosh, everything is great and everybody should buy a home. I'm also not going to be Chicken Little and say the sky is falling. What I want you to understand is that it's a very volatile market. I think the overall premise of the U.S. economy is headed in a good direction. That's going to help housing demand because as people feel confident, consumer sentiment goes up. People are going to want to own homes because they feel confident in their job going forward. Affordability is the problem. The city of Sacramento just passed the biggest change in any housing municipality on how they look at zoning, and they're basically passed into city zoning regulations that say you can build a multifamily property on any lot you want in the city of Sacramento. You don't have to have special zoning for that. It's called the missing middle. The missing middle is filling extra units by adding an ADU or turning a single family residence into a duplex or a triplex or a fourplex. The city of Sacramento made the biggest sweeping change last month of any municipality so far, and they're moving in the direction of trying to solve the housing crisis. Because even though we have a strong foundation for housing, and I don't see the housing market crashing at all, what we also have is a hard time for people to afford to make the mortgage payment. And that's creating a situation where the average person can't buy a home right now. And so we have to make smaller homes. We have to make more affordable homes because interest rates aren't moving down anytime soon. They're creeping down, but it's going to be a slow creep, and it's getting to look like it's going to be an even slower creep than anybody expected. So that is definitely creating some concerns in the marketplace. All right, so I have a couple more things I want to talk about, but I'm going to pull up this question. So Young says, are Republican administrations bad for housing markets? So I'm going to caution, and I'm going to say, I stay completely out of the political debate. Now, you're not asking a political question. You're asking a factual question about what one party's impact historically has been on the market compared to another party. And I will 100% answer that question. But I'm not sharing my political views. I'm not asking yours. And I won't get into a political argument about which is better or which is worse. So here's the answer. Republican administrations want less government involvement. In general, they want the economy to grow. They don't want excess taxes. And that in general is going to be good for business. Now, when it's good for business, it means that people who are employed are going to be more confident in their jobs. They're going to be more willing to spend money, but that's bad news for inflation. Inflation has gone up over the last few years because of supply chain issues, because of the money that was being printed by the federal government after COVID, and everybody got free money. And the more money you have, the more money you spend, yet there's fewer goods to buy. And so if you have more dollars chasing fewer goods, prices of those goods go up. And so that created inflation. And so what we're looking at, and Young confirmed, yeah, he's not looking at anything political, just based on previous history, which is exactly how I'm answering it. So what you've got is the Republican administration is great for business, great for the economy, which is bad news for interest rates. Because interest rates, when the economy is doing really good, the Fed's job is to kind of throttle it back a little bit. Okay, kind of make sure the economy doesn't get super red hot, inflation doesn't take off out of control. And so they start raising interest rates. And so that is a concern. Now, I'm not answering your question about the housing market yet. I'll get there. So the good for the economy, good for business, bad for interest rates. One of the other things, though, about the administration that's coming in is they're talking about getting Fannie Mae and Freddie Mac back to being private entities. So I'll give you a quick history lesson going back to 2008 when the housing market crashed. And then Fannie and Freddie were losing a whole bunch of money because they had backed all of these mortgages and everybody was losing their home. And Fannie and Freddie were about to collapse, and the government couldn't risk Fannie and Freddie collapsing because they were the backbone of housing finance. And they were private companies, and the federal government stepped in and said, I'm taking you over. I'm taking you into conservatorship. Conservatorship says, I don't trust you to take care of your own needs. I'm going to tell you what to do. And an agency called the FHFA, Federal Housing Finance Administration, was created. And the FHFA has been the overseer of Fannie Mae and Freddie Mac for the last 12, 14 years. Well, now the new administration is saying we want to make them back to being their own entity, and they can make their own decisions, which is good for the shareholders of people who own shares of Fannie Mae and Freddie Mac. But guess what? If Fannie Mae and Freddie Mac become private entities again, they're going to need to make profit, more profit than they're making right now, which means they're going to want to keep rates higher. So their incentive is to make rates higher when they're private companies, which is bad for interest rates, which is a challenge for the housing market. And so here's the simple answer for you, Young. That is, the new administration is going to be neutral to housing as far as I'm concerned. The previous administration was really pushing, hey, we want to create first-time home buyer programs. I don't think the new administration is going to do that very much. I don't think, now the CalHFA programs, those are all going to stay, but like federal programs, let's give you a $10,000 stimulus or $20,000 stimulus for buying your first home. The prior administration, the Democratic Party, if they had won, were talking about doing that. I'm not sure that would have been a good thing for housing either, because we don't have enough homes built. So the fact that rates are going to stay higher for longer might be a good thing for fixing the housing problem, which is we need to build more homes to catch up to the number of people who want them. And I think the next 4 years, we're going to see fewer people wanting to buy homes than what we would have seen if it was a Democratic administration. So long story short, I think that it's going to keep interest rates higher for longer. I think that that's bad news, and I think that's going to be offset by the good news that people are going, that based on history, people are going to feel confident in their jobs, they're going to feel confident in their income, and they're going to want to buy a home. And so those two are going to balance each other out. And I think the market's going to be stable over the next 4 years. But I think that's a good thing for the market. It's not a good thing for the people who are looking to buy their first home, because it means it's not going to become any more affordable for you until we get more inventory built, more homes built, like what Sacramento is doing with allowing infill, allowing for somebody who owns a single family home to put 2 more houses in the backyard and turn it into a triplex without having to go through as much red tape. Okay. There's another thing that the state of California passed 2 years ago that say when somebody does that, when they build another house inside their lot, they can actually split it off and sell it as a separate property. So there's some weird new, I'll call them new instead of weird. There's some new things that are happening that are being more creative in how we can make this kind of thing work. So hopefully that helps answer your question. I'm going to get back to what I was going to cover. 2 more things and then I'm done. If you have a question, feel free to post it in the comments and I'm happy to answer it like I just did. First of all, conventional loan limits have been announced. 806,500 officially effective January 1st. If you are using down payment assistance, you have to wait until January 1st to reserve your loan to get those limits. If you're not using down payment assistance, you're just doing a regular conventional loan, you can do it sooner. As a matter of fact, we're locking them right now. So conventional loan limits have gone up. FHA limits went up as well, but their rules are different per county. And so you have to look it up based on the county. Shoot me an email if you have questions on that. I can get it for you. But FHA's loan limits are not eligible until after January 1st. And that's based on the date we pull a case number. So when you get into contract, the first thing we do before we order an appraisal is pull a case number. And if your case number is pulled before January 1st, you don't get FHA's limits. All right. The last thing I want to talk about is Dream for All. And it looks like I have another comment here. Oh, you are right here. Yep. So Young already asked me the question that I'm about to cover, which is Dream for All. Young said, will there be an extension for the Dream for All program? So 9 months total. So guess what? There is a second extension that has been announced. CalHFA reached out the Monday before Thanksgiving and emailed everybody who had a voucher right now that was about to expire at the end of December and said, hey, Good news, you can go into the portal and you can apply for an extension. And all of my clients who have applied got approved for their extension. That means they're the original voucher winners. Only had until September 26th. Wait, scratch that. You got an extension. They have until December 25th. Wait, scratch that. They have until late March. I made a phone call today to Cal Haffa, and I have not heard back from them, but I'm asking them, is this what we're going to expect? Like, is it just going to be extending for as long as you want and keep extending over and over and over again? Because I'm not sure that's fair to anybody on the wait list. Now, I'm not trying to be unfair to the person who won originally, but at a certain point, if you can't find a home in 6 months or in 9 months, are you looking for something that's impossible, or are you unable to qualify and you're just hoping you can stretch it out and go further? A lot of the clients that I've talked to, it kind of feels like that's the situation. I'm not saying all of them by any means, but there's some of them that are looking for something so specific, or they're shopping right at the bottom end of the price range of their market. And every time a house comes up, it's gone right away. And so they're having a hard time making it happen. Well, one argument is say, hey, at a certain point, let's give it to somebody else, because maybe they'll shop in a little bit higher price point or a different city or a different neighborhood that has more inventory. Otherwise, this money is never going to get used, because the same people who have been looking for the same thing that haven't been able to find it, they're continuing to search for the same thing over and over and over again. And I don't know what Cal Haffa is thinking. I thought the idea of one extension was phenomenal. I thought that was great because, hey, 3 months to find something is pretty short. But 6 months? If you've been looking for 6 months and you can't find something, you're looking in the wrong place. You're looking for the wrong thing. Now, I know that the holidays are not a great time to buy a home, but guess what? There are a lot of homes out there for sale, just might not be in the neighborhood or the condition or the price point that you're looking for. But that doesn't mean something's going to come up in March either. Doesn't mean it's going to come between now and March. And so I don't know what the right answer is, but I am trying to find out from Cal Haffa, is there going to be a maximum number of extensions? Are you just going to perpetually let somebody continue to extend over and over again? And then what happens to people on the wait list? Because there are a lot of people waiting to buy a home because they're number 25 on the wait list, and using my math and what I've been projecting, they were confident they were going to be able to get a voucher at some point. And I apologize because I never expected them to do a second extension. And that's really changing the outlook for people who are on the wait list. So I wish I had good news as far as wait list. I have great news for people who have a voucher, because if you got a voucher, hey, you have more time. You have now until March. And it tells the people who got a voucher later, somebody who got a voucher in October, and they're saying, hey, John, I'm nervous that I got this voucher in October. Are they going to give me an extension like they did the first people? Well, they gave the first people 2 extensions. So there's no way they're not going to give you 1. And I can't imagine they're not going to give you 2. Like, extensions are like candy in a candy store that, I don't know, that's a wrong example because candy stores have to make money. So giving it away for free, I don't know. But they are giving it away for free, and they don't care. And I don't know why. But I do know if you have a voucher and you're worried about an extension, it sounds like you shouldn't have to worry. Now, maybe they're going to draw a limit that says 3 is the most or 4 is the most. But if you haven't extended yet, no worries. I'm confident you're able to get another extension, and pretty sure you're going to be able to get a second extension as well. So, gang, it doesn't look like there's any more questions. I appreciate everybody listening today. I hope everybody has an absolutely wonderful weekend, and we'll talk to you all next week. Thanks, and enjoy your time. Bye-bye.